are the ratios as well. So if we could state the top three, will help us.
So first is, the velocity of deposit gathering should improve. Certainly should help CASA. I think the pricing of deposit should get better. So that is very important for us also. Third, we are very capable of doing supply chain financing, sales invoice discounting, purchase invoice discounting. But many of the mid-sized, large MSMEs, small corporates, they are not sure if small finance banks can deliver on that. So I do think our upper end of customers in mid to large MSMEs, small corporates, where we can serve them, will also find it comfortable to deal with us. So if you think about it in one simple way, it certainly helps cost of deposit, speed of deposit, quality of borrowers who are probably not available to us today in the right manner. I think those would be the three key advantages.
Yeah, no, absolutely. And we'll see when that comes through. Mr. Kamal, good morning. Good to have you with us here. Just this, the here and now, which is the big push which the RBI has given with these cuts, repo and CRR, etc. as well. How does that change the trajectory for you on? Let's just start with margins first. Once all this feeds through the system, banks lower their cost, and how does that work?
So I think first big picture in my head is it's growth oriented. It's very positive. So it's economy should do better. I think the regulator has been ahead of the curve, so which is brilliant. And that means very positive news for certainly credit growth and certainly the way of the credit quality also. So I think two things we should take into account, which is credit growth will be better than what it would have been without the cut. And credit quality will also be better because clearly we'll see much more economic push. From a NIM perspective, yes, we will start seeing deposit rates go down. We haven't really got there as yet. But in the next day or so, we will be cutting our deposit rates. And simultaneously, we'll be seeing a drop in our lending rate. So yes, it will be more in favor of the borrowers and the savers will get slightly less money.
So, Mr. Kamal, hi. Yeah, morning. On NIMs, I think you ended the year at around 7.6% net interest margins, FY25. Now, as all this plays through the rate cuts, but the fact that, there's ample liquidity as well, what will it mean? For this year, what's the outlook on NIMs?
So I think our NIMs have been showing a compression from 8% last year to 7.7% this year, mainly because our balance sheet is turning secured. That's been our regular push from the day we started the bank. So we are 70% secured. Every year we move the needle. So we move from 60 to 70 and our NIMs did come down. So we expect that compression of NIM of turning secured anyway to take our NIMs down by about 10 bips. I would imagine that depending on what we do with deposit rates and the loan rates, which we'll decide in this week, we probably add a NIM compression on the 10 bips at best.
Another 10 bips of NIM compression. That's because of your stated strategy of, going for more secure deposits. But on that, Mr. Kaval, it's quite curious because a lot of lenders have been pushing on the unsecured side and probably very happy now that, the norms are no longer as onerous as they were in between. We heard the RBI governor also say that perhaps the worst of the unsecured stress is over. We heard that in the policy on Friday. So why is it that you don't want to, or you want to sort of, come down on this segment a little bit? And I go back to that growth question as you wait for your license application to pass through for turning into a universal bank. What is your strategy on growth? Where will it come from? And also the timelines that you're working with, where you're expecting to hear from the RBI.
So listen, when we began the bank in 2017, we had 100% microfinance business. So everybody is different in what their composition is. So our parentage was 100% unsecured. Now, when you start a bank, you're taking deposits and your first real obligation is to make sure depositors' money is returned back on time and in full. For that, you need to have, at least in my mind, and what our board and strategy agreement was, that we should make the bank 80% secured, which means home loans, LAP, MSME, supply chain, gold loans, two-wheeler loans, something which is asset-driven, business-driven, and has collateral backing it. And that was a primary purpose, that we should have 80-20 secured, unsecured mix. So we are moving in that direction, and that hasn't changed. And I must say, over 7 years, it does seem like the right answer. I'm not saying unsecured business is not good. It's certainly a great business, but we have enough of it. We have less of secured, so we're growing that. Also, I must say in our unsecured business, which is largely microfinance, we have gone ahead and put it under the guarantee programs also. Because having seen the stress of last year, we thought to take away any amount of event risk, it's best that we even get the unsecured business under the guarantee program. So maybe slightly more conservative in our thinking.
Okay.
But our bias is that we rather have a more predictable, very consistent performing bank. And if we have to do less unsecured to get there, then that will be our strategy.
Just a quick question on the MFI book itself. You had sounded a little bit cautious earlier, and you were one of the first to point that out with regard to stress in the system. Do you think the worst of the MFI stress now is behind and things, are on the mend and looking up from here on?
So I would say that two things. One is, I think the MFI new normal is not what it would be if you took what existed in terms of collection rates, etc., prior to March of 2024. So I think we'll all have to think of what the new normal would be in an MFI business. It is not as easy as it used to be, for sure. Second, I wouldn't think that the worst is over. I would think that worst has reduced, but it's still hard work. I must tell you that we've also seen that till December last year, we thought it was over. Then we had a Karnataka ordinance, which was, of course, meant for a good purpose. But obviously, a lot of the people on the margin want to make misuse of it. We saw a bit of more slippage. We are just steadying now. But yes, I would be very watchful, clearly, in this segment. And there are enough and more reasons why we should just watch it for some time. I wouldn't say the worst is over, but I would say, yes, the peak of the worst is over. But we are not back to MFI after 1 year of stress is back. I wouldn't say that.
Peak of bad news is over. That works for now. Thank you very much, Mr. Kanwal. Good luck with that banking license, and we'll speak more as we go along. Appreciate your time here on CNBC-TV18. We'll take a break. We're back. As promised, we've got a real estate discussion coming up with Knight Frank and Tata Realty. So will the RBI move spur real estate demand? Additionally, that's the question coming up. Okay, welcome back. Markets up 25 points. It's a more settled kind of screen as compared to yesterday, and most definitely as compared to Friday when things were flying around. Well, we've spoken so much about banks, right? But real estate is another area where markets have bid up stock prices on the back of expectation that this will at the margin maybe, help demand a little bit more. Shishir Baijal is Chairman and Managing Director at Knight Frank India. Shishir, good morning. Great to have you with us here on the program. Thanks very much. Prashant, this side. So how does one think about this? Will this, this will help people with EMIs, etc. But a rate cut, will it really spur demand, end-use demand, in your opinion, Shishir?
I think it would. I think the banks front-loading the rate cut to a 50 basis point cut is a substantial move. It's far higher than the 25 basis point cut that the market had anticipated. And I think this front-loading and the transmission of this to EMIs will most definitely help the affordability, and it will definitely boost the residential segment. Primarily, the one segment that will really help will be the affordable, or if I would say close to the 50 lakhs to 1 crore segment. If you look at the residential change that's happened since the pandemic, during the pandemic time, this segment used to have close to 45% share of the market. And that time, the market used to have close to 160 odd thousand units a year. I'm talking about 2020. The market's gone up to 350,000 units a year, while this segment was languishing and the share came down to 25%. So our feeling is that these rate cuts would really have a meaningful impact in this segment. And I do hope with the transmission that's going, the affordability picks up and the demand for housing picks up in this segment, which perhaps has the largest segment of demand in our country.
Shishir, great to have you on. Thanks for joining in. Rate cut, liquidity and pricing, we've rarely seen a connection, right? Especially in super hot markets like Mumbai, pricing is a different beast altogether. But, take us through some of those recent trends as well, because there's been some evidence or at least some chatter about, a lot of inventory building up, some concern on, if you leave aside the marquee transactions, say in Mumbai, which is, sort of the big bulge bracket transactions that have happened, where the registrations are showing some signs of a slowdown. Could this just be an interim patch, or is there some concern building up, particularly in some of the top residential markets, NCR or Mumbai?
I think you'll have to have a look at it because by looking at it just on unsold inventory or the inventory building up may not be perhaps the full answer. If you look at the velocity of sales, if you look at the age of inventory, I think they are all fairly healthy. In fact, perhaps at the healthiest level for a long, long time that we've analyzed. So in most of the cases, the length of unsold inventory is less than 8 quarters at the max, which is fairly healthy. The issue really is in the lower segments. I think whilst there has been a plateauing of the numbers in the higher segments, but there is still substantial traction there, as we have seen even in the Mumbai segment. The above 5 crore is still showing a robust growth. The little plateauing of the growth is really in the medium and in the less than 50 lakhs.
Yeah, because those registrations, I'm talking Mumbai particularly, I mean, that really made big headlines, right? Because registrations had fallen 4% in May, which is why the question, and this is a sub 5 crore market that we're talking about.
Right.
Is this just a small blip, or would you read anything more into it?
We'll have to look into this. It's very, very early days for a month's data to come in. But if you look at it the same month, the total revenue collected by the exchequer was higher, and that's fundamentally based on the higher segments. So our ardent wish really is on this front loading of the 50 basis points and the transmission that many of the banks have given for the EMIs, that this will boost the demand of the segments under 50 lakhs and 1 crore. And I think that's where the major potential lies in demand.
Yeah,
as well as for developers to come into it and for supply to increase within this segment.
Yeah, we've had listed developers, we speak to regularly on quarterly earnings. Some of them have moved away from that segment to more premium because that's where the demand has been booming. But maybe this will revitalize that segment once again. Sanjay Dutt is also with us of Tata Realty and MD and CEO of Tata Realty and Infrastructure. Sanjay, good morning. Great to have you with us here. Prashant this side. Just give us a quick sense of your kind of lay of land as far as Tata Realty goes. How much is commercial? How much is residential at Tata Realty?
So we have over 10 million square feet of commercial, which is built and leased, and about 20 million is under design and development. And roughly 13 million square feet under residential across major markets is under design and development again. So I would say nearly 50-50 portfolio. At one time, we were predominantly residential, but now it's a very balanced portfolio.
Okay. And on the residential side, how does, which segment are you mostly present in? As Shishir was talking about, I mean, focus is under 50 lakhs. That's where it makes most impact in that sense. From Tata Realty's perspective, how does this play out?
So last 5 or 6 years, our strategy has been to focus on key metros, the top 5 or 6 cities. And as a result of that, because it's a very urban focused strategy, we are in the more premier and mid segment and select few luxury segment. There was a time when we were unaffordable, but over the last 5 or 6 years, we have changed a bit of strategy and focused more on urban growth.
Sure. Mr. Dutt, that's why the question, hi, good morning, Surabhi here, and that's why the question, and we started asking Shishir about exactly this.
Yeah.
How closely linked are interest rate cuts to real estate demand in this, a mid-premium to slightly more premium housing segment? Because for affordable, one can understand every 1,000 rupees saved in a home loan EMI matters. But when you're talking about mid to higher end premium housing, then isn't it more closely linked to, say, the wealth effect from the stock market or job security, the bonuses that you're getting? Do interest rates really matter when it comes to the affluent housing segment? Mr. Dutt?
So, one take is, of course, from the consumer point of view, lower EMIs, it does matter because you can actually upgrade yourself from a very compact 3-bedroom to a normal 3-bedroom or a slightly better amenity and quality development. At all segments, it does matter. And I think if you look at it from the developer's angles point of view, the cost of capital, which has been an issue, the cost of construction, which has been rising, and the land cost, which has gone up, any relief by the government and interest rate does make a difference. And therefore, it makes the whole sector overall healthier.
Premium segments will be, as you said, I think the impact, point taken there, but I think it's also interest rates, lower interest rates, higher stock prices, higher
Feel-good
gains.
factor, yeah.
Not feel good, real factor.
So the higher the Nifty goes, the higher the demand for premium real estate, right?
Bigger capital gains and that's been, of course, the prime driver, stock market gains, at least in big cities like Mumbai, etc. Thank you very much, Shishir and Sanjay, for joining us. Short conversation, but I think useful to put the context straight as far as the RBI cut goes. We'll just quickly run through what markets are doing at this point. And we've got, 40-point gain on the Nifty, 25,140. Mitesh is back with us with a quick check on what things are looking like. Mitesh, I think your view was you get a big open, wait for a 30-40-point dip and then sort of get in. I think that is materialized. Is this the dip to buy into?
I think, I would be very happy to buy into Nifty right now. I'll take a stock about 25-30 points below today's intraday low. Also, on the stock side, I have buy calls. Apollo Hospital is one. It's a buy with the stock just below levels of 69.20 for targets of 7,100. And Biocon is the other one. Biocon is a buy. Keep a stock below levels of 339 for targets of 350.
Okay, those are individual trades as well, which Mitesh is putting out right now. We'll take a quick commercial break here. We're going to come back and we'll focus on a bunch of stocks. Grasim, for example, is in focus, but we'll also look at commodities with Manisha. Stay tuned. Coming up.
Flip-flopping between red and green, that's the shape of the market. But the good thing is that there is buying at lower levels. The Nifty is back now, up to a 50-point gain. That's equities for you. Let's figure out what's the latest in commodities. We have Manisha with us for all the headlines. Manisha, which one are you tracking today?
Well, metals, and within this, I want to first talk about silver because this doesn't, get off from headlines there. We've seen further gains come in the overnight markets onto this one. 2% of gains in silver in the overnight markets, and we are 8.5% up in the last week. And with that, it's mirroring on what gold has done till now in this year. 27% up for 2025 till time. Well, there is strong investor demand that we have noticed, not just in the Asian markets, but in the Western world as well, especially US and Canada, where the silver coins really seem to be doing quite well. Add to that the fact that there are supply shortages in the near term. And in any case, 2025 is a fifth year of deficit yet again for silver. That has been supportive. The markets also are looking at a record industrial demand as well, from solar, photovoltaic and electricity as a segment. And that has been supportive for silver as well. But the other metal that also seems to be doing quite well in the very near term has been copper. 1.5% of gains in the overnight market. We have seen 6% of gains for copper in the last 1 month. And for this year, it's up by nearly 22%. There's renewed optimism between US and China in sense of trade agreements. That has been supportive for all metals across, more so for copper. And then it also has been about US tariff that perhaps could be coming in for copper. Remember, US has been talking about it, has also been investigating, and that premium has worked in sense of copper. You are also looking at supply concerns coming in from South Africa and some countries within Asia and South America as well, which has been supportive. Also, LME inventories have continued to decline, and there is a backwardation into the markets as well because the cash copper is trading at a premium of around $75 a ton to the 3-month copper. So the markets also are looking at stronger data, stronger demand for copper in the near term, which continues to be supportive for the prices. The last plate should show you on what we've done in this year until now for many of these metals. So the best of the gains really for the space comes in from platinum, 37% of gains onto this one. Much of these gains clearly have come in the last fortnight or so. Gold and silver, with the kind of catch-up that silver has done in the recent few days, gold and silver both are up by 27% now for 2025. 22.5% of gains come in for copper. Palladium is another metal that should come in on your screens because we're trading in the positive on that was as well, and a double-digit 21% of gains. And then everything else is trading in the negative for this year. Aluminum, zinc, 3 to 11% of a decline. That's exactly how iron ore, tin, nickel also seem to be trading in right now. So negative for many of these metals, but it is about PGMs and copper, palladium, platinum, which are trading in the positive for this year.
Thanks a lot for that, Manisha. Well, let's focus on one of the top gainers from the Nifty itself, Grasim. That's post the Morgan Stanley note that's coming on the stock. They've gone ahead and upgraded the stock from equal weight to overweight. The target price as well, they've raised it from little sub 3,000 rupees to around 3,500 rupees. Now, they say that Grasim has multiple opportunities playing out that could lift the share price in the medium term. So let's highlight the 4 points. First up, the paints business, they say, has fared much better than expected earlier. So they've gone ahead, they've raised the paints business valuation across scenarios. Now they estimate close to 360 rupees per share in the SOTP, or the sum of all parts of Grasim share price. Earlier, they were giving it a value of around 150 rupees per share. Next up, Ultratech remains the largest value driver for Grasim, and Grasim is likely to benefit from the multi-year earnings compounding story at Ultratech. That's point number 2. Point number 3, on new age businesses, they're also scaling up fast, they're driving earnings, and also there is value optionality at some stage. That's point number 3. And finally, there's a holding company discount that they expect to continue to moderate from here on. In short, they go to wind down by saying that Grasim is one of their top picks. Put this together, the stock is surging away in today's trading session, up close to around 4.5%. The other stock that I'm looking at is Hindalco, and I'd given it as one of the stocks of the morning. And the reasoning is that overnight they went ahead and they announced a capex plan in the Middle East. That's in Saudi Arabia, as well as in the United Arab Emirates. Now they've gone ahead and they've announced a couple of projects out there on the same seamless pipes business as well. So the reason that the street is excited about this is the street was concerned about no growth. Now, since they've announced capex in the Middle East, that's what will help them in terms of growth going ahead. Point number 1. Point number 2 is, if you look at the stock price move in the last 6 months, the street, since they were concerned about no growth, the stock was down close to 30% in just 6 months. And point number 3 is on the valuation parameter. It trades at sub 5 times EV upon EBITDA. That's FY27 EBITDA. So valuations as well were supporters. So put these 3 points together, announcing capex, stock had already got slammed, and point number 3, valuations attractive, explains why the street is bidding up the stock, up 10% as we speak.
Ooh, big move on Jindal Saw. Thanks for that, Nigel. Well, with that, we will take a very quick break. Come back on the other side, and it will be time for a special segment of The Economy. Today, Lata speaks with Soumyakanti Ghosh, member of Finance Commission, and the PMEAC on the monetary policy and the state of the economy.
Welcome to It's the Economy. The Reserve Bank policy of last week shook the market with its jumbo 50 basis rate cut and a totally unexpected 100 basis point cut in the cash reserve ratio. That, of course, starts from September. However, the governor moved the stance back to neutral from accommodative, signaling probably there's very little chance of more rate cuts. The Reserve Bank cut the inflation forecast for the year to 3.7, left growth forecast unchanged at 6.5, which anyway is above consensus. Today we have in the studio an economist who is a member of practically every key policy-making body in the country. Joining me is Soumyakanti Ghosh, Group Chief Economic Advisor at State Bank of India, member of the Finance Commission and member now of the Prime Minister's Economic Advisory Council. Well, he is also member of several committees of the Ministry of Statistics that are revamping the IIP, the CPI and GDP. So we really have someone who has a hand on every aspect of the economy. Soumya, thank you very much. Welcome to our studio. I don't think we have interviewed you in the studio, so thank you very much for dropping in.
Thank you.
Okay, let me start with with the policy itself, though I want to ask you economy questions. Would you say this is the terminal rate, with the governor saying there is very little space, as well pulling the stance back to neutral?
Yeah, thank you, Lata, for having me on the show. Now, I think as per the conversation which the governor had post-policy, he clearly said that the monetary policy has done enough to uplift growth. So from that perspective, it looks like this could be the terminal rate. But my sense is that I think if food prices remain within control, given the fact that RBI has cut the inflation forecast to below 4%, and even next year if the inflation is going up, it will continue to stay between 4 to 4.5% range. I think if the inflation behaves properly and if there is some disappointment on the growth outlook, I think there is still some marginal window to cut the rates. It is difficult to say whether it could go to another 25 or higher than that. But we are possibly towards the end of the rate cut cycle.
Okay.
But we are not yet there.
Okay. So your base case is terminal rate is 5.5, but a small possibility of another cut?
Small possibility of another cut. Maybe in the not in the August policy, but maybe beyond that.
Beyond that. Okay. You said if growth disappoints. Is there a chance at all that growth will disappoint? Because we've got fairly decent numbers for the fourth quarter, in fact, better than expected. And now with this double cut, and once the double cut is over, the CRR takes on, is there a very good chance that growth will surprise on the upside?
Yeah, I think the fourth quarter number, actually the good point is that the fourth quarter number actually has surprised on the upside. We are all expecting, actually, the market was expecting a very good growth number because of the
6.8 on GDP and 6.5 on GVA.
But the good thing is that the GVA actually has also surprised on the upside, 6.8%. So from that perspective, I think the growth numbers have not disappointed. And the first quarter of the current year also, I think you know that the issue is basically the geopolitical conflicts. Every day is a new uncertainty in the era of the markets in terms of the conversation, in terms of the way the trade deals are moving up. So my sense is that as of now, 6.5% growth projections which the Reserve Bank has made at some point of time has lowered from 6.7% looks a possibility that we may have to, we may agree with. Earlier, there was some...
The consensus I got was 6.3.
Yes, but now...
RBI stands at 6.5.
Yes.
So do you think
I think there is now
will upgrade?
I think there is now a larger, after the first quarter numbers, there could be a larger probability of the growth actually converging towards 6.5% or more. So from that point of view, I think the growth numbers may not disappoint, but you have to keep the window open. You need to understand that there are geopolitical conflicts. You also need to understand that the monsoon could be little days of scarcity in monsoon could actually put the food prices up. As an example, I think after the pre-monsoon showers in the end of May, there has been a shortfall of around 20-25% across India. So these are moving things. So my sense is that yes, we are on the course of getting closer to the RBI projection of 6.5%, if not more. But we have to be cautiously optimistic that this has to be sustained.
What's your own number?
Fiscal. My number as of now, we have not revised it upwards. We are at 6.3%.
Okay, but you think that there is
a possibility of an upside to it.
Okay. But what about credit growth itself? The policy has done so much for it. Besides the repo cut, which of course this is slack season, but once the busy season begins, you have this massive CRR cut coming in. Will that mean what is the credit growth forecast?
See, I think with a nominal GDP growth rate of around 10% or below, the credit growth forecast, even if we assume and multiply for 1 to 1.1 or 1.2, should have been closer to 10 to 11%. That was the earlier consensus. So the central bank purpose is that to make the system abundantly liquid, continue with a liquidity surplus regime, announce an pre-medicated CRR cut so that the banks know that where they will be standing for. And there is also, if somebody is willing to invest, that also is front-loaded. So my sense is that if there is demand comes back, most probably the demand, it will be led by the retail credit growth. I think it could be around 12 to 13% overall. So from there could be a 1 to 1.5% difference, because the estimates show that if the cut in the CRR, allows 2.5 trillion
Yes.
lendable resources, and that could have an 1.5% impact on the credit growth. So even if the impact is 1.5% or even 2%, the credit growth moves up closer to 13%, which in itself I think will be could be possible to support a growth rate of 6.5% or beyond.
Okay. Now comes my worry. You know, there is this huge amount of 2.5 trillion coming, and as your latest report said, the money multiplier may be even 6 times. So we are going to see the CRR cut having a multiplier effect on loan growth or deposit growth. Is there a possibility that we will spark financial excesses, asset inflation? Because as you said, nominal GDP is 11%, but credit growth grows way above it at 13 or 14% because of excessive liquidity and CRR cut. So will we end up driving up asset prices?
No, I think regarding the first point of asset price inflation, yes, there is evidences that there is a liquidity. You have seen also in the last year, the markets actually have ran away. But I think in the Indian context, the link between asset price inflation and monetary policy the monetary policy feedback loop is not that clear, because in India, even after you have so much amount of demat accounts, the number of people actually investing in the financial market is not that, not significantly higher. So from that point of view, the asset price inflation, like in developed markets, which has a very good monetary policy feedback loop, that may not be as strong in the Indian context. So that's point number one. The point number two is that I think the important point to note about this CRR cut, I think, when in a rate cut cycle, and given the fact that deposit rates are going to be cut by many of the other banks, we're in an EBLR regime, that actually, the CRR will actually act as a cushion, because there will be fight for deposits in a lower, if the rates are lowered, obviously the banks actually will have not much incentive to leave the savers. So in that point of view, the CRR could act actually as a buffer of ensuring that even in a declining deposit growth rate scenario, the lower reserve money growth which is happening is not translating into a lower broad money growth. Because the other important point in the last 4 years, the 70%, the growth in the reserve money has declined from around 18% to around 4.3% last year. And 70% of that is attributable to the lower currency leakage, so increasing digitization. So I think all these are actually acting as buffers to push up the money multiplier, and that will help to ensure that the money supply growth is at least equivalent to the nominal GDP growth rate, or if not more.
Okay. Now let me come to, you said when you were referring to credit growth, you said it will be largely driven by retail. How confident are you of CapEx? I'll tell you the worry for the current GDP forecasters. One is the tariff rate, the tariff war. But the other is also that the government is now done enough for CapEx growth. This year, they have their eye on fiscal deficit lowering, so CapEx is not pushed up so much. You have gone to a lot of states, you've gone through the states' data. Do you think states will pick up the CapEx baton, or do you see private sector, since you are anyway heading, at the helm of a large bank, you see private CapEx picking up the baton?
See, I think I'll give you an interesting anecdote over here. Last year also in FY25, the 6.5%, the 7.4% growth in the last quarter, and an overall 6.5% growth in largely often on the back of a back-ended capex. If you remember, from April to September, the capex growth actually was quite low. And from September to March, after the government changed a lot of rules regarding that 1.5 trillion interest-free capital loans to the states, it did pick up. And the center also actually went on a capex overdrive. So ultimately, I think it was able to meet almost the entire target, which was around 11 trillion, which was in the last budget. So from that perspective, my sense is that this year the capex growth is likely to be a little more back-ended. So if it is back-ended, and that's why I think the timing of the CRR is an interesting coincidence, that you are putting the CRR cut at a time on a staggered growth rate, whereby the busy season starts and there is a possibility of the back-ended capex available. So my sense is that as of today, yes, the capex cycle looks a little bit on the thinner side. There has been a survey of NSO which says that it's not likely to be as strong as last year. But my sense is that if it is back-ended, the way it happened last year, and the states take up the baton as they have taken up, then I think it could be good for the economy.
So you think government capex will pick up
Yes.
in the second half?
Yes, it will mostly pick up in the second half, because I think by that time we should have a clear idea about the trade deals which have come through, the India-US trade deals which have come through. So if it comes through, I think the markets will have the clear bit idea, and hopefully more of back-ended capex in the second half, and that pushes up the growth.
Okay. Well, actually, we are out of time, Soumya. I wanted to ask you about the new CPI IIP numbers, of which you are a committee member. You expect it to dramatically change?
No, I think the new CPI, actually the measure, I'm a member of the IIP committee, so at least I can talk about the IIP. But IIP, I think there has been a lot of revision. Already they have reduced the time lag of the data. And I think they're also trying to do some innovations. Okay. I mean, the committee is doing
by way of collecting data.
Collecting in terms of, so I think the data collection actually could get a huge boost in terms of all the initiatives which the government is doing.
Okay. I'm sorry, out of time. We're not out of questions. We will get you on another day. Thank you very much for joining us. So that's the word coming in. Capex growth, especially from the government, could take a leg up in the second half when the CRR cut will also come in. So we should have a boost to growth much more in the second half. We have to wrap up on Bazaar on that note after a break. Chartbusters.